Hello friends, welcome back to my channel. If you like the content, please click like and subscribe the channel. So starting with the today's topic, I'll be discussing about spreads and mainly vertical spreads with respect to options. Lot of members have been asking me what is a call debit spread or what is a put credit spread. All these kind of spreads we'll be trying to understand the basic concepts of each, and we'll also try to understand in what kind of market scenarios do we get inside these trades, or do we try to trade these for making a profit. So first of all, the basic words, whenever someone says, okay, someone got a call credit spread or a call debit spread, so the basic concept, what is a debit spread and what is a credit spread? Simple, it's very simple. If as a user if we are paying, we are on a net basis, we are buying something, we are selling something, so on the net difference of both, if we are paying money from our account, that is a debit spread. Okay, so that's a debit spread, means the end result is we pay, the user pays. Okay, credit spread means we are collecting from the market. After the net result, we sell something and we buy something, the net result of both, we collect money from the market. So if you want to correlate with simple terms, debit means you are buying something, that's called buy to open, and if you are doing something credit, means you are doing a sell to open. Okay, it's very similar to sell to open. Okay, so first of all, these two words, you have to be very clear about these two words. Now coming to the vertical spread, what is a vertical spread, what are the basic concepts? It's very quite easy to understand. If you have basic knowledge about options, it's quite easy to understand. So what happens in a vertical spread is we choose the same expiry date and same type of option for buying and selling. Means you are either using a call option, then you have to buy a call option and sell another call option. You don't need to worry about put. If you are doing a put spread, put vertical spread, either a credit or a debit, we'll talk about it. You have to buy a put and sell a different put, sell a different strike put of the same expiry date. Okay, so that is a put vertical spread, but the expiry date is same. Okay, so this example I have given over here, say call and then sell same type of option, that is a call, and both of same expiry date. Okay, we'll see with clear examples on that. So this is one main part. Then comes a very basic and most important concept of a vertical spread is how much you lose and how much you gain. Okay, so this is most understanding thing that you need to understand, most important thing that you need to understand. So the maximum value of a spread will be the difference of the strike prices. Okay, I have also given an example over here. Yeah, minimum value will be 0 if it expires out of money. If both options expire out of money on the day of expiry, means the price of that stock was out, means it did not reach the strike price you have chosen for your spread, so that means it expired out of money. Okay, it's easy to understand it with terms of call options. To have given and call options means suppose you took 1100 call and sold a 1105 call. So the minimum value it will reach if Tesla closes below 1100 on the date of expiry of these options, then these options will expire, both of them will expire for 0, so the minimum value will be 0 for this spread. What is the maximum value? As the most important concept that I was trying to say in this slide is the difference of this strike price. Okay, so the difference of the strike prices is, as you can see, it's 5. Okay, in US you have the lot size as 100, so The maximum value of this spread will be 5.00, means maximum value in terms of dollar. You have to multiply by 100, so that will be 500. Okay, so for suppose if you have bought this and sold this, you are in a kind of a call debit spread, which I just now told. If you are paying, okay, then at the end, if Tesla rises, say suppose up to 1130, then this will achieve almost like 4.5 or 4.75. okay, then you can sell your option for 4.75, that will be $475. Okay, very clear. If Tesla rises say above 1200, then it will reach, this call spread will reach to 5.00. okay, that means you can sell your options at $500. So this is the most important concept that you have to understand. Why people go for spreads. Okay, they have very clear knowledge about how much they are going to gain and how much they are going to lose. Okay, depending on the type of spread you have entered. Now coming to the basic examples of verticals, sorry for the spelling mistake, vertical spreads. So basic examples of the vertical spread. Let's start with a call debit spread. This is one of the popular spreads, which it's most easy to understand, because most of our understanding goes in terms that things will rise. Okay, before coming into options, normally all the traders, the beginners, they buy something. They buy say Tesla share, they bought at say $750, and then they were able to sell at $1100. Okay, so you buy something at low and sell something at higher. So the most easy type of a spread that you are trying to understand over here is call debit spread. Means you have purchased a call and you are selling a cheaper call. Okay, means as I tried to explain with respect to Tesla in the previous slide, you purchased a 1100 call, which is most you can understand that this call will be expensive. This call will be maybe say $40. Just for example, I am saying it is at $40. Okay, of some expiry in month of May. Okay, and you are selling a cheaper call. Cheaper call means you have to rise higher on your spread. Okay, so you are rising higher, 1105 call. So definitely if this 1100 call is at 40, so this particular call will be somewhere say around 38. Okay, just for example I am saying, I do not know the actual prices of some date in month of May. Okay, so you are selling that for 38. So you are buying for 40, you are selling something else for 38. So how much you are paying actually? Okay, you paid out of pocket is 40, then you collected 38, means you are paying $2, means $200, 2.00 with respect to option price, and actual when you multiply it with the lot size, you are paying $200. Okay, so that is a call debit spread. Okay, now when do we trade this? We trade this when we have a bullish view with a lower risk. Okay, so very well you can understand that if you had to buy Tesla call, you would have to pay 40 into 100, that will be $4,000. Okay, instead of that you are doing a spread, so you are just paying $200. Okay, because you sold something for 38, but limited gain. Okay, when it comes to naked option, say if you purchased that 1100 call for 40, the gain is unlimited. It might go, if suppose some big announcement comes and Tesla goes to say 1300 in a day. The next 2 days Tesla goes to 1300, so that particular call option which you bought for 40, it might go to say $200. Okay, so you would end up paying, you would end up gaining huge. That is one good advantage, but The risk is $4,000. If Tesla even slides down, say suppose just by 10 or $15, you might lose a lot of money on your naked call. Instead, you are paying just $200. So the maximum you're going to lose on a spread, on a call debit spread, is $200. But there is a catch. The catch is gain is limited. The maximum you are going to gain, even if Tesla goes 2500, Tesla doubles more, it goes above double its price in next 1 week. Even if that happens, the maximum you are going to gain is 500, because call debit spread will the maximum it can go is the difference between the strikes. Okay, so 1100, 1105, so it can go maximum to 500. Okay, but it is a good strategy. At lower risk, you no need to just keep watching, you no need to worry if Tesla falls by 20-25 dollars, or I would talk in terms of percentage. If Tesla falls by say 2%, no need to worry immediately, it might gain on the next day. Okay, and you have just risked $200 from your account, okay, instead of 4,000. So that is a good thing. The other one with the other spread with the bullish view is put credit spread. This is very popular among the pro traders, the advanced traders of options. Credit spread means it's similar to sell. Okay, similar to sell. What here you are doing is you are selling a put and then you are buying a cheaper put. Earlier we were buying a call and selling a cheaper call. Here we are buying a cheaper put. Okay, I have kept these two examples together because both of these examples are of bullish view. If we talk in terms of Tesla, we think Tesla will rise. So instead of taking this particular call, we can also do say sell 905 put, which will be expensive, and buy 900 put. Okay, so example of this will be sell a 905 put and buy a 900 put. So 905 put will be expensive, 900 put will be cheaper. Okay, net result, we receive premium from the market. We receive some premium from the market. Suppose 905 put of some day in a month of May, it was at say $25. Okay, and 900 put, 905 put was at 25, 900 put is at 23. So what is happening is you are selling something for 25, you are buying something for 23, so you are collecting 200 from the market. Okay, you are collecting 2.00 as an option price, and if you use the lot size, you are collecting $200 from the market. Okay, so that is a credit spread, put credit spread. Again, here we have a bullish view. What it is a kind of sell to open, means you have sold first and you are going to buy later. So what you want in this to gain profit, what actually you want? You actually want that the price of both these puts reduce. Okay, so later on, after say a week or so, this is just beginning of April. Okay, after 1 week, the price of Tesla rises, so both of these put prices will reduce. Okay, it will reduce even if Tesla doesn't do anything, if just remain at the same place. Even with that, the price is going to reduce because of the theta decay, the time decay in options. Okay, so uh, after 1 week, suppose the Tesla rose by $50. Okay, so these put prices will become from 25, the 905 put will become say 11. Okay, and from 23, the 900 put will become 10. Okay, so now what is the difference? The difference is 1, 11 and 10. Difference is 1. Now in your account you will see that it's at 1.00. The current value of this spread, how much you sold for? You sold for 200. Now it is at 100. If you want, you can square off, means you can close both the options, and what will happen is, as a result, uh, you sold something for 200. Now you are buying it back for 100. Okay, you are buying it back for 100. That means you made a profit of $100. Okay, so this is how people gain in put credit spreads. You might have seen some examples around, floating around on WhatsApp, that so and so person sold something for sold some spread for this much value, and now after 2 to 3 days they buy it back at lower value, so they gain that difference. That is, the difference is their gain. Okay, now I just told about these two options. Let me just show you with real examples. I have opened marketwatch.com. If you create a login over here and you just search for a stock, here you have a search button. Yeah, you can search for the stock. In this you can just click at options. There is a button for options. Okay, and then what I will do is I will go to May options. So this will list both type of options, calls and puts. If I just scroll at the side, you can see that puts will also appear. Yeah, on the right side, yeah, on the right side you have puts, and on the left side you have calls. So now this is May 6th. May 6th, currently the Apple price was 174 on the closing of April 1st. Okay, so I want to do a call debit spread. How I will do is, I think Tesla will go above 180 by May 6th. Okay, so what I'll do is I'll buy a let's just go with the this offer price 3.25. Both, in both cases we'll go with that. Okay, for clear understanding. So we are buying this one at 325, and we have to sell something at lower a lower call option. That is, let's say select 185 call option. So we are buying at 325, selling at 1.182. So the difference, that will be I'm not using calculator over here now. The difference will be, say, just um, 118, and then 25, around 143. Okay, so the difference around 143. You are paying 143 out of your pocket because you are buying expensive, selling the cheaper one. So you end up paying $143 from your account, instead of paying 325 for a naked option. You are just paying 143. Okay, not only that, there is another advantage of doing spreads is the risk is little bit less. Now in the coming weeks, say suppose Tesla falls to 170, falls by 4.3 dollars. So what will happen is both these strikes will reduce. Okay, so now you can see at 3.25, this might become because Apple stock fell by $4, this might go to 2.00. Okay, and 185 call, this one might go to 1.00. Okay, so it will, the difference as you can see is 100. Okay, so if you purchase $325 and it reduces to 200, so you are actually losing 125 on that particular naked option. Instead, if you are doing a spread, you purchased net of 143. Now since Apple lost $4, you lose on both these call option value loses, and the difference is now at 1. Okay, so you are just losing $43 instead of 125. You are just losing $43 if Tesla goes downward. Okay, if Tesla rises, If Tesla rises, again and again I'm using the Tesla word. If Apple rises, my bad. If Apple rises, both these call options will rise. Okay. If Apple rises by say $5, this will go to maybe, because of its delta value, it might go to some 5.5, and um, this one might become at 3.5. Okay, so now the difference, as you can see, is 2.00. You paid 143, now you will get 200 if Apple rises. So that is where this is a bullish view. A call debit spread is a bullish view. Now I'll quickly go over a put credit spread. Okay, now I don't think Tesla, I don't think Apple is going to fall much from here. So what I'm thinking is Apple is going to rise back from value of 174. Okay, so what I'm going to do is I'll just pick say 160 put and 155 put. Okay, let's pick 165 put and 160 put. Okay, I don't think that by month of May and date of 6th, by 6th May, this strike is 6th May. I don't think that by 6th May Apple is going to go below 165. So what I'm thinking over here is I'm planning to sell this one and buy this one. So you are selling an expensive one, buying a cheaper one. So here, as you can see, the difference is almost up to 100. Okay, $7 less than 100, so 93. Okay, so you sell at 268, buy at 175, and you are collecting a premium of 93 from the market. Okay, now if Apple is going to rise by $5, both these put options will reduce. Okay, both these put options will reduce, and you can see that after a week or so, when Apple price rises, this will become, say, suppose 1.5, and this might become maybe 1 or maybe 0.8. Okay, so let's say if it becomes 0.8 and this is become 1.5, so the difference will become 0.7. Okay, so you sold something for 0.93 and you are buying it back for 0.7, means uh, you sold something for 93, now you're buying back at 70, so you made a profit of $23. Okay, so that is how it goes with a put credit spread. Okay, I have two more spreads to talk about. I will talk in the next video. Thank you for watching. Yeah, and don't forget to subscribe and like the video.